Good afternoon, Matthew. Thanks for having me on the show today. My name is Robin Birchall. I'm the CEO of Giyani Metals. My background has been in the natural resources extractive sector since about 1999. I was in investment banking for about 12 or 13, 14 years, and subsequently went over to a buy-side company where I was placed on a number of boards and built a mine. Very shortly before I joined this, I'd stepped off the board, and I had one of those kind of chance encounters at dinner. And the original founders of this company asked me, "What are you doing?" I said, "Well, I'm looking for another CEO position." And they said, "Well, we need a CEO." And that was back in November of November of 2017. And we've taken the company from relatively early stage. It's not really greenfield exploration, but effectively greenfield exploration, all the way through to almost complete with the feasibility now. So yeah, we're progressing quite nicely.
Great. Robin, thanks for coming on, and we'll let people know. We have had a couple of other attempts to try and connect, but internet has not been our friend. So I appreciate you making the effort and coming on to run through the story. So, okay, manganese. Need to understand that market first. We need to understand what the thesis for it, and what the future holds. So can you just give us a little background about broadly manganese uses, applications, and then the market as it stands today?
So look, the best way to think about it is like nickel, okay, or even cobalt. They're really steel inputs, right? They're for making steel and doing special things with steel, for special applications of steel, be it buildings or whatever. And all three of the metals, nickel, cobalt, and manganese, pretty much have that similar kind of application. That side of the market, you can completely ignore. We're in the other side, which is the chemical side, which is the same as nickel and cobalt, nickel sulfate, cobalt sulfate. You can also think about lithium, the lithium hydroxides, and other chemical products. These are products that go into the battery manufacturing process. And I just give you a very simple explanation. So they mix these in a solution into a reactor. They calcine them. It turns into a black powder, which is that's the black box, the nano ones, and the BSFs. So that's the IP, and that stuff is then printed like on like a laser printer onto a sheet of aluminum, or maybe sometimes bound with silicon, and that's a cathode. So we're in that side of the market. That side of the market is very new for all four of us. It has been growing considerably in the last 2 or 3 years. Prior to that, it was a bit of a hobby market, if you want to call it that, or like just a village type exercise. And what that means is that the battery manufacturers used to make their own cathode active material. They would make their own manganese sulfate, because it was a relatively small niche part of their business. It was for hand tools and rechargeable hand tools and toothbrushes and things like this. Now with this, it's really an industrial process now with the original equipment manufacturers, the car companies. They want to separate out and specialize in what they're good at, which is making the cathodes and making the batteries, and they want to leave the production of the chemicals to us. And there's about a handful of us who are doing it. And it's exactly the same in nickel and exactly the same in cobalt. So it is quite an opaque market in terms of pricing. It's quite hard to find, but you can look at some pricing around the world. The Shanghai metal market does have some pricing, but it's very China specific. To find the European and North American prices, we would direct you to this. We use the industry standard guides that are used by a number of us, which is CPM. You can look at their pricing and their forecast going forwards, and like the other ones, it's pretty favorable.
Okay, so right, so similar to nickel, cobalt, we understand that market well. So talk to me about the size of the opportunity for you, because I think you referenced in your presentation that there's only one company outside of China that produces the high purity manganese sodium monohydrate. You would be the second. So does that mean there's a kind of bifurcation in the market, given the kind of opaqueness of pricing, and what's the opportunity in front of you?
Okay, so yeah, so maybe a little bit clearer. So there's a couple of companies that make the MSM, the high purity MSM, but they don't control their own ore resources. They buy ore from other places and make it. So the Japanese do that. It's kind of like they outhouse their in-house, or they outsource their in-house business. They spun it off and put it somewhere, and then it could sell to a number of the Japanese companies as a source. So that's a small one. And then you have you have the spin out, which is owned by Prince now, of the old Aramet chemical business. So they about 10 years ago now, they bought Aerochem, and they also make the MSM. They used to own, because Aramet is a big manganese producer, they used to own their own ore, but when they got into trouble with some debt covenants, Prince, which is a very private US company, chemicals company, specialist chemicals company, bought them. And so they no longer own their own ore resources. Now there's a new generation. There's about 3 or 4, maybe 5 of us who are coming down the track at various stages of development. I would say ourselves and one other are the most advanced, and the opportunity is pretty significant. Considering if you look carefully at the way the market is going, I noticed it now traveling around in Europe by car. The market is starting to mature, which means not every electric vehicle is a Tesla, a 90,000 pound car, whatever it is. You're starting to see lots more Renault Zoes and Hyundai Ioniqs and these kind of vehicles, the mass market, which Volkswagen and Fiat Chrysler, et cetera, are going towards. They're looking at higher nickel, higher manganese because it's cheaper. And as you know, like the really interesting or important thing about that benchmark of maybe $100, $110 a kilowatt hours, you can just multiply that by your battery. And just like the way we think about vehicles now, which is, are you driving a 5-liter V8? You're going to say, well, I'm driving a 55 or 45 or 90, and that's going to be the number of kilowatt hours. And you multiply that by $100, that's how much your battery pack costs effectively. And then you can compare that to what the cost of the vehicle is, right? So as they can drive that $100 lower, it means that they can fill into the mass market space, which is where the millions of vehicles get sold.
Right. Okay. So different design and different use cases for batteries. I get it, but just trying to put it in a context of, do I invest into a space which is going to very quickly get saturated, and therefore, price falls off, your margins fall off, et cetera. Can you give me a sort of sense of what demand looks like going forward, given the design use cases as we currently understand it, and where are you in terms of the 5 that are coming along? Are you at the front of the pack, back of the pack, and obviously with this, and with this kind of integrated model that I think you're looking at, does that give you any kind of competitive advantage over them? Yeah.
Okay. So let me answer. There's a number of pretty good questions in there. So look, the market overall has shown that there's these huge forecasts, right? So people are like, is it going to happen? Well, if you look at where we have been going already in the last 18, maybe 24 months, the demand is meeting those types of quite steep growth. We actually are slightly worried about it because it's going to take us a couple more years to get to production. And we're tied maybe first of the new entrants to get to market. We don't want them to we don't want them to be choked by a supply problem in Volkswagen and Ford and likes of these mid-market people. They need the units quite badly, and we can feel that in the discussions that we have with the likes of LG Chem and some of the other battery manufacturers. They're like, when can you give us demonstration samples, and when can we qualify you? We're going to need this stuff very badly to meet our output. And I don't know if you've seen, it obviously is not just battery, but it's a number of factors. But if you've seen recently that Volkswagen has basically said, we're done for this year. That's it. All our cars are sold. We haven't made them yet, but we can't sell any more. If they could, they would definitely sell more cars because there's increasing rapid demand for them out there. And just anecdotally, it was a neighbor of ours, friend of mine in Denmark, waited 18 months to receive their Skoda EV. I mean, that's a really long wait compared to what we're used to. that just gives you an idea of how congested the market is. Of course, it's not all batteries, but definitely our area will start to impact on that. So yeah, in terms of the growth profile, it's really enormous. It's, you're talking millions of units that they're going to be necessary. We would not expect. Well, our growth profile is also pretty significant compared to what we've published in the past. I can't talk too much about the feasibility because it's almost there, but we would expect to be expanding our production, but we would still struggle to be more than 20% of demand, I think.
Of global demand?
Yeah.
Okay.
We'd struggle to 20%.
Right. Okay. Well, 20% of global anything is good news, I suspect. But what do you suspect the economics going to look like?
We're pretty much. So you were asking about competitive advantage. Well, yeah. Being integrated is an enormous competitive advantage because we don't have to move all these empty tons around. There's a producer who they don't make the sulphate yet, they make the metal in South Africa. And we've had a number of discussions with them, and they just love the fact that they would love to be in our position of owning their own ore. And they would move, and the first thing they do is they move their facility as close as they could to the ore, which we already have. We're in a great country, and it's got really good infrastructure. It's got a surplus of power. It's not affected by the whole South Africa situation, and highly skilled workforce. So we don't need to go very far. All of these little things add to our competitive advantage, and it probably puts us right at the bottom of the cost curve. It's hard to see the cost curve at the moment, but where we're forecasting we'd come out is definitely at the bottom of the cost curve.
So so I'm intrigued by. Okay, I get the opaqueness of the market, and it's kind of difficult to answer specifically, some of these questions. But how do you plan a business around an ex-China business? Because if I look at some of the graphite guys, they're very careful to say to me, "Look, we don't want to be such an irritant to the Chinese that they decide to make our lives extraordinarily difficult in terms of price-wise, right?" And given that manganese is such a large proportion, like plus 90% of the current global processing capacity is in China, and supply is in China, you've kind of got a little delicate dance to do there. Really, it seems to me. Or do you think that because the ex-China demand side of things will, give you maybe an incentive price which will allow you to compete and not have to worry about global pricing?
Well, we know what the pricing is in Europe, and it's a bit more in North America. If we put those prices into our model, which we don't, our NAV doubles. So those are pretty hefty. We're quite conservative. Because we were told right from the beginning, don't expect to get paid more than Chinese prices. So we use a kind of Chinese pricing model in a way, because it's much better for me as a senior manager of the business to force my team to be economic in the bits we control, and then if pricing is good, that's just like the sugar on top or whatever. The cherry on the top. So if we control our part of the business and stay at the bottom quartile, if prices go up, it's just going to flow straight to the bottom line. And I'm a shareholder too, right? And so we're going to see a significant share price appreciation. But just to come back to your question about China, look, to give you an example of it. So there's one very important battery manufacturer that we've been speaking to, who we're talking about, potential prepayment for some offtake. And they indicated, they said, look, we'll take 30,000 tons from you of MSM. But if we like your product, our European business would buy 150,000 tons. Well, that's all we produce. That's everything. They buy everything. And they are a significant producer, but no single manufacturer is more than about 20% of the battery market. So that gives you an idea of the scale and scope. And that's in a couple of years when we're in production. That gives you an idea of the scale and scope of how big the market can become and where it's going to grow to. And we think that, so our strategy in terms of moving our material, marketing our material, is to try and achieve a good offtake for maybe a quarter of our material, where we might give some price incentive to them for the first one. And then everybody who comes after that is going to have to pay up, and we'll reserve maybe 10%, 10 or 15% of our material to go into it's called the broker market, where we will supply the spot market to make sure there's a spot price. It's not terribly different to, what happened with iron ore 10, 12 years ago when they wanted to create a spot market for it so that you could have, instead of, because, a CRU price or whatever, an AMEC price or something like that, that's a panel. They just ask people, what did you pay last week? That's not the same as spot. We wanted that if you are, Panasonic or whoever, or British Volt or somebody like S Volt or South Volt, you need a bit more in the spot market that you can actually come and say, I want to buy this week 1,000 tons. What's the price? Bam, done, published. So that we can make this a bit more transparent.
Okay, this is a kind of important area because pricing affects margins, significantly, and there's lots of ways you can come at this model. So we've spoken to cobalt producer, cobalt developer going through a similar process to you at the moment, and we talked about how these conversations go when you're at the sort of demonstration plant stage. You've got 15, 20 people testing product. You then need to make a decision about, well, who do you go with? As you say, you can have companies come in and say, we'll take everything you've got, right? And you could go, well, let's look at risk mitigation. Does that work for us? Is there, their balance sheet is presumably, if it's an OEM, significant, and the risk is quite low as far as your funders are concerned. But for you, it sounds like you want to try and take advantage of the ability to squeeze out some of the additional margin through the spot market. That you will try to create yourselves. I mean, do you think that you as a business can create your own spot market in that way, or is this going to have to be a kind of collective movement from some of the other developers or a couple of? Well,
we are in the process of creating an association of pre-cam manganese producers.
Okay,
so that we can. It's no different than in the other, like the Gold Council or something like that, to help people understand what demand and supply looks like. Transparency is the most important thing. We want to be absolutely transparent because the more price transparency there is, the better it is for us as a smaller business or entity compared with the very, very large OEMs and what have you. But just a little bit of a difference is, there's about five or six of us. There's not 50 of us like there is in lithium. It's a little bit, it's more difficult for them to play off against each other. There's only really, quite frankly, right now, two of us who realistically will get to production. So of course, more will come later. But some of the discussions we've had with this other guy, particularly graphite. Developer who's a little bit further ahead of us, he said, look, you want to be number 1 or 2 in those discussions because number 3, 4, and 5, it's a lot harder with the OEM because they say, well, kind of okay, I kind of covered for my supply needs. I can give you a little bit of incremental demand. That's about it. So that's why we made a number of decisions. Our feasibility is being constrained on the size, so it can be done more quickly. We've quadrupled the resource in the last year, gone from whatever it was, 1.3 million at the end of 2019 to 5.3 million now. That's like almost 4 times the size. And we would expect, I would say will definitely give us more tons, probably at a higher grade. And we've almost completed the infill drilling for the reserve. And we've got an exploration area. We'd expect that to increase to 5.2 million tons somewhat as well. So we just keep adding incrementally additional tons, but we've constrained it so that we can get the FS done to stay as far as we can out front. Easier for us on a capital basis, easier for us negotiating.
Interesting. Okay, so you, in terms of the economic studies that you've been through to date, and probably including the feasibility study next, you've deliberately kept the size down to assure yourself, give yourself comfort that you may be able to raise the capital required, but this is what then a modular exercise for expansion once the kind of revenues are flowing in terms of the design, because you've kind of just handed over to you mentioned a specialist engineering firm for the construction of the demonstration plant. So
correct.
Is it a kind of cookie cutter modular design?
Well, look, there's going to be, the moment that we finish the feasibility, there's going to be optimization of it. I mean, it's almost started.
But that's different, right? So the optimization gets you, a few percentage points more. But how do you?
But it's about the modules.
Right. Okay. In terms of that,
that's what the optimization is about.
Gotcha.
It'll be about optimizing. When do you go bigger? Like, how soon is it? Do you take your existing plant and, you can say for the leach tanks, you can have your 6 that you have now, and you can lay foundations for 4 more, or do you just go, we'll put another 6 right next to it? That's what the optimization will start to be about. Do you just cookie cutter and put it next to it, or do you just leave extra space to make your throughput bigger?
I hear you. Okay. So that's fine. Good common sense there. With regards to the position, so how long will that take to build and you actually be pumping out enough material that your potential strategic partners can test?
Oh, the demonstration? No, the demonstration plant is completely separate from the modular design. The demonstration plant simply makes material to qualify. It's not commercial at all. So
right.
That's to be finished construction by the end of this year and producing in the beginning of next year.
Got it.
Okay. So, but that's totally separate from the full scale plant, which is in the feasibility study.
No, I understand that. It's a demonstration plant. So what I'm saying is, it will be producing and throwing off enough material by when? Did you say just now?
Early next year.
Right, early next year, and you've got a number of strategic partners lined up to test that material. And
but what'll happen before that is, so it's not quite. It's a ramp, if you want to call it that. So we're waiting some final test results. I think they've done today, but I haven't seen them. That'll be the spec. So we'll give that to all the guys, and hopefully they'll all come back and say, yeah, that's great. Then in about 4 or 5 weeks' time, we'll say, right, we've made 2 pucks of this size, 2 kilograms. We'll chop them into pieces and send them to them, and they'll say, right, we're going to get these independently tested so that this spec here, we know that our one that we tested looks exactly like yours. And then they'll say, right, when are you going to make 10 kilograms? And we'll make some button batteries, and so it's all steps over the rest of this year. And eventually when we get to demonstration plant, they'll say, okay, send it to me. And I'm actually going to make full scale batteries and put them in my ID4 or my Renault Zoe, and I'm going to drive them around a track for 10,000 kilometers and see what happens to them.
Right, that's what I was getting at. I just want to understand those baby steps to that point, because at that point, and the interesting thing you just said to me was like, you will design it to spec. So there's one spec. You don't have demand. There's only one HPMSM being output. Because normally OEMs say, or battery manufacturers say, look, we need it to our spec in terms of purity levels and so forth. There's one product. Is that right? Yeah.
Well, we may have slightly made a rod for ourselves, our own back, and we've said we'll meet the most difficult of everybody's spec. Now, that we'll see. I mean, that might be a bit of a rod for our own back, but if we can make it, There's this thing called WTI or Brent, right? Well, if we can be the spec everybody benchmarks against, that would be great.
Right. Okay. And then at the point at which you either agree with some strategic partners, 1, 2, 3, however many of those, you will produce their spec. Presumably, and would that be 3 different lines required, or again, would all 3 have to pick yours and yours alone?
Yeah.
Okay. Wow. Okay.
It'll give them flexibility because they will be. We know So the spec is divided. It's 16 elements or something like that. The most important ones are the sort of transition metals. So nickel, cobalt. Zinc, chrome, and then there's slightly non-trend like copper and lead and things like that. We know on all of those ones, we are extremely low, like low ppm levels. So we're great on all of those. So that's the metals, kind of the ones that you don't want turning up in your cathode, and you certainly don't want them turning up metallically, because they're the ones that cause dendrites and all those kind of problems, right? Then the second set of ones is poisonous and radioactives. cadmium, boron, and selenium because they're poisonous. And if you have a fire in your battery and things like that, you don't want gaseous cadmium being inhaled by bystanders to an accident, things like that. So on those, we're extremely low as well. Then the final one is which has been the most difficult for us, is the soft metals, potassium, sodium, things like that, which they aren't terribly fussed about. They don't really inhibit the battery from functioning, and they're not poisonous, but they also need them low enough. So those are the ones that we've been the last little while or whatever, getting rid of, and up until we had made that announcement recently that we were pretty good with all of them. So it gives them what they might need is flexibility in some of the other areas. If somebody's sending them a cobalt sulphate that's got 50 ppm of copper, they can blend it with our 2, right? And bring it down to the 25 or the 10 or whatever they need, right? So we can probably, well, we're a small company, we'll establish ourselves, and then we'll start to say you got to pay a premium.
Right. Okay. Understood. So again, just in terms of the kind of the path forward. So I'm sorry getting into kind of the weeds of it here, but it's kind of interesting the way the companies think about it, these things. So if we look at the feasibility study, which is coming up, you've got some decisions to make. You want to focus on the kind of the economics and the technical and how you actually produce the product. But with the feasibility study, you also sort of need to talk to the market, right, and signal things. So you have signaled that this feasibility study will be, I think the phrase thrown at me was bigger than the PEA, and I'm not quite sure what bigger in the context of some of the questions sent in means. But in terms of the resource, do you need to say, well, look, the resource is bigger, the economics are better, the margins are better? I mean, what are you focused on for the feasibility study, and who are you aiming that at?
Well, look, there's a couple of interesting points to deal with there. Okay, the first is we kind of have suppressed our pricing regime from the beginning. Okay, we're seeing a massive expansion in price, but that's also being slightly offset by an increase in OPEX and some increase in CapEx. So we've got a doubling of price compared to what we had before. We've got some increase in OPEX and some increase in CapEx. And those are split between inflation driven and probably just underestimating on our part 3 years ago what it actually took to make this stuff. Either way, we probably end up with the same kind of 58 to 65% margin, something like that. I don't know yet because we're finalizing OPEX and CapEx at the moment, but we will have a very significant margin going forwards. But in terms of making it bigger, look, there's no question the resource has grown considerably since what we theoretically pushed through the mill in the PEA. It's probably double, but it needs to double again after that. But the work you have to do metallurgical test work on everything to be able to get it to feasibility level study. Outside of the main K.Hill body, we haven't finished the actual metallurgical test work on the extension, even though it's exactly the same. It still has to be done. So we constrained the size. So it is bigger, but we've constrained it, and we'll do that immediately afterwards. Okay. The met test work is actually ongoing, but it just takes weeks and months to do it, rather than delay the FS, because the biggest question we thought the market had about us was, does it actually work? Can they make the product? Right? So we're answering that. It's bigger, and we're answering that question, and we'll give you some nice economics. But I think we'll probably show in the so 43101 has a very specific set of sections you have to follow in order to publish, and there's one nice little section 24, where you can publish other additional information, and we'll probably give a high-level economic view on the whole deposit, so that there's a bit of an arm wave in there, so you can look what it looks like for 5.3 million, not 2 million.
Right. Okay. Interesting. No, but I think you're right. It's like, show this thing works, show there's a route to market, show there's, you understand what the financing needs to look like, and maybe there's some conversations that are being had or can be had or will be had to cover that off. So just on while we're talking about money, you raised some money in December, about $11.5 million. How's cash now? Where's it take you through to?
We've got $17.2 million in cash at the moment, so we're very well funded at the moment. But we've got a lot of capital in front of us. So whenever there's something interesting in the market that somebody wants to offer us additional capital, of course, we're open to those kind of discussions. We're not very happy with where the share price is at the moment, but you know what? Prepays are non-dilutive. So we definitely are having those kind of discussions. They take time, and we're not in a terrible rush for additional capital. But yeah, additional capital when you can get it is much better than when you have to have it. So we always look at what's available out there, but we're almost starting to get grown up enough to actually have a weighted average cost of capital model and think about which component of the capital is better for the shareholders. It's quite interesting the transition from a purely equity finance business to a variety of other types of capital provision. So we're in that phase. And there's some and then it starts. You start to have these discussions. We have a number of discussions with other financiers who are more strategic. They're sort of like, we love the project. Can we give you $5 million now, and then so that we can give you $50 million in 9 or 10 months?
Yeah.
And then it starts to be, okay, well, what are the additional costs that you want with that? What are the kickers and the warrants and all that kind of stuff that they want alongside that, placed against what would be a very positive message to the market saying, not only is the feasibility done, but here's a real financier who believes that we can build this thing.
Yeah, it's interesting. I guess that's hark back to my previous profession was sitting at the other side of the fence, which with the kind of prepay or the structured financing, it's a lot more fun in a seller's market. So, I mean, can you just maybe just for the sake of people listening to this, kind of you've outlined some of the variables there with regards to prepay and some of those kind of structures that you can put in place in terms of the documentation, but. Talks about the pricing upon which that's based and the timeline from, say, now, if there's conversations happening now, versus if they're happening when you're running a little bit closer to the end of your $17 million. So, what's the timing look like for you, and what does that do for your negotiating power during that time frame?
Well, I would say now is better, right? Because we have lots of cash on our side, and we do see a number of these types of offers, but there's a quid pro quo to that, and they're looking at it going, I'd say 2/3 of them say must have feasibility completed, and 1/3 of them are like, we see they're in the end, they're inside the data room, they've signed the NDA, they've done all that, and they're like, we're happy this is going to work. We're happy with the risk that we're taking on this. So then it comes down to some other items, particularly on the prepay side. It's like, well, who are you? What's your credit like, and what are your CPs going to be on this? And how much do you want, and what are we providing to you in terms of that? So, and the most difficult one, which everybody's dancing around at the moment, is how are we going to price this? Now, we haven't got that far in those discussions yet, but my suspicion is that somebody in the chaebol in Korea, or the equivalent in China, or in the whatever is the oversight board of the in Germany, will look at it and go, "Are you kidding me? Like, how much of this stuff are we going to buy? $60 million a year? Give them $5 million now. Give them 10, whatever it is. Just give them it compared to what else we're spending. The $54 billion that we've bet on making the ID3 and 4 and 5, you better not run out of, we better have manganese. So here's $50 million, go and give 10 to everybody. We'll see. We're coming to those very, very interesting discussions, like right now.
Yeah, I think so, and we're seeing that with other commodities too. In the context of OEMs and battery manufacturers, it's in the context of the total spend and time invested in terms of the design. It's hard to thrift out at the last minute if you can't secure supply, for sure. So interesting times for you on that front. Okay, so on the kind of money side, on the conversation side, so I understand it. And forgive me for not kind of diving into the project proper here, but given your past pilot phase and you're now sort of into demonstration plant stage, I think I can be forgiven for not wanting to go through the kind of Botswana jurisdictional risk or product or technical risk at the moment. Just again, if I may, kind of nail you down on some of the conversations which you're having today. Are you looking at Europe, given the premium you think you can get there, or are you looking at the US, given the extended premium that you think you can get from that market? Because typically African projects seem to get a lot of attention from China, and they come along with the money. And companies tell me, "Oh, we're not going to take Chinese money." Turn around and take Chinese money. So where's your head at with regards to how this thing gets actually financed going forward?
Let's divide that up. So we're looking at primarily from a supply chain perspective, we are primarily looking at Europe, Korea, and Japan. Okay, not so much at China. Obviously, CATL is very interesting. I mean, are they Chinese or are they European, whatever? I mean, yes, absolutely. If we sell to their plant in Poland, it can go to Poland. But we're not really spending a lot of time with the rest of the Chinese market. We're because, and it's mostly driven by ESG, to be honest. The most important is your carbon footprint. Ours is going to be very, very low. We have our Minvaro. We're lucky that we started working with Minvaro like 2.5 years ago when we pretty much couldn't afford them. And now they seem to be everybody's choice. But so they've done a lot of work. We look like we're going to have probably the best carbon footprint in the industry, bar one other maybe. And that actually, surprisingly, has trumped some of the spec. So you can be over by 10 ppm in somewhere, and they're like, that's fine because your carbon footprint is so fabulous. We'll blend it away if that's a problem. So that's the first thing. The second thing is US. They're too far behind at the moment in terms of their development. Now they might catch up. They don't have a permitting process like you have in Europe, so they might catch up. But for the moment, they're just not far enough along to be commercially ready to start going, I need X tons. It's the same as we spoke to Northvolt maybe 3 years ago, and they literally said to us, we're not worried about manganese. Right now we're only discussing cobalt. 3 years later, and they're like, okay, this is how much we'd like. The US businesses seem to still be at that kind of not up the curve enough to really be there. But that's on the supply chain side. Now they probably will provide some capital, so we can use that to, kind of segue into the capital discussion. We absolutely do not seem to need to have any Chinese capital. There's far more than enough capital that is being kind of waved at us. I don't want to say offered; it's not quite right, but waved at us from the traditional Western capital provision mechanisms, whether it be equity, whether it be, royalty stream, even bank and ECA, across the full spectrum of capital. George is probably not on this call because SocGen wants to talk to us again. They talked to us 2 weeks ago, but nothing has changed, but they still want to talk to us again, because they're very interested in what's happening. And it's the same with BNP and Standard Chartered, a number of them. And they're by far and away the slowest part of the market. But that gives you an idea of, there's definitely seems to be enough provision.
Right. Okay. And do you think that you need to kind of work on the scaling part of this story, the modular bit? We talked about it a little bit today, because I think, you're setting out whatever, 75 million Canadian today. Yet the discussion we're having is around a much bigger market, much bigger opportunity, much bigger portion of the global supply. yet the market's not rewarding you for that. It's been a fairly erratic year for you and more recently for lots of people. It's been a very negative time for the last 10, 12 weeks or so. What's the kind of trigger moment that will help the market understand the scale of the opportunity, the margin of the opportunity in front of you? Is it getting the demonstration plant built and actually throwing out some of these test modules, the test products? I mean, where do you think it comes from?
I mean, I was going to be flippant and say I've heard of this company called Crux, and I believe that's one of the trigger points. Or, no, but it is. I mean, all joking aside, we need to get the story out there, and people need to understand it. That where we are, and I think does it. I've been in the market a long time, so view. Why do stocks start to run when they do? Sometimes you've been beating the drum for a while and it starts to run. You're like, well, nothing has changed from 6 months ago, but now the stock is going up. I don't know why, but it just does. But we just need to continue to tell people where we are. No doubt about it. They want to see the feasibility. They want to see what the capital is, what the OPEX is, and where's your product. That's not, not very far off. And we'll get to that. And I would hope that then there's some very stock specific stuff out there. We have some 35-cent warrants that are expiring in the not too distant future. I expect that once we get through that and people have seen what's happened, the stock will start to appreciate.